MBS Highway members, welcome to the webinar. Happy to be with you all again. I'm Diana with MBS Highway. I'm with Barry Habib, Dan Habib, and Megan Anderson, who's behind the scenes, but she's with us here today. And two very special return guests, Michael Wall and Stephen Snowden. We brought them on for you last year to talk about tax strategies, and here's Michael joining us now. And we wanted to bring them on again to talk to you about how to prepare for 2026. So I'm sure you're familiar with them. Of course, you're going to learn a lot today. Take a lot of notes and enjoy.
Yeah, actually, how to really help yourself for 2025, because I think you guys could still help people for 2025 if they're going to be having a large tax burden, how to alleviate that. Is that right, Michael and Steve?
It is. It is. First off, great to see everybody. Sorry, I'm a little bit. Lighting's not perfect. I'm actually here in Barry. You would know it better than I. It's a Pendry property in New Jersey, right by Trump. I can't think of the name. Old Macy's estate. Pretty cool, by the way, if you want to check it out. But, anyways, yeah. No, there's a lot of stuff happening in 2025. In fact, that's the reason I was a little bit late jumping in. I just finalized, sent to some things, opening a deal, which is amazing. One of the deals that's going to be another 5-to-1 mineral deal this year. And with Barry, I mean, last year it ended up being, and Dan, we ended up, I think, throughout the country, help families save somewhere in the ballpark of 259 million in taxes in 2024. So, I mean, that's a big number. Why were we able to do that? Well, obviously, the type of clientele that we work with are higher net worth, higher wealth, and you're really using strategy that we put together in a lot of ways in a variety of different things. So, the goal today, and Steve did a great job of putting a deck together. Did a lot of work. He really puts a lot of, we'll call it, behind the scenes work in. We all know how that goes. And to really kind of highlight some of the few things as well as others that we can do. By the way, you look great, Barry.
Oh
Came
man,
out of
thank
it.
you.
Came out of. You're doing your thing. You're looking good. I'm watching you online. Like, this guy's looking sharp now. I like that.
Oh, thank you, buddy.
You're welcome.
Well, excited to have you guys. And, you guys not only are great with tax sheltering and such, but also, you guys manage money professionally as well. So I thought it'd be interesting maybe if we kind of get your take on what's happening in the market right now. We know that it looks like it's 100% for a rate cut September 17th, but how's that going to impact asset prices? Oftentimes it could cause more global liquidity, which can find its way into those things. But where do you see the market going? And then, of course, would love to get into the slideshow and some of the exciting tax stuff that either our customers could take advantage of, or if they're not able to, maybe they can help some of their higher net worth customers that they have to take advantage.
And full disclosure, guys, I have worked with Michael and Steve to save money on my taxes. It has been really helpful for me personally to reduce the amount of tax based upon some of the tools that they have. We went over it last year, guys. A lot of MBS Highway people that attended the webinar last year took advantage of it, if I'm not mistaken, correct?
Yeah, I would say we're in the ballpark now of helping roughly 20 to 25 of you guys, which has been, a wonderful blessing, and we're excited to keep continuing to help you guys.
Okay, great. All right.
And I've used it the last 3 years personally as well, and it's been fantastic.
Yeah. So to your question, Dan, as far as markets, rate cuts, I mean, I think we've all been I think we've all been waiting for that. Barry's talks a lot about the idea of marrying the home, not the rate, right? So I don't want to. He says it better than I. But at the end of the day, in relation to markets and investments, one of the things that I will say, at least for us in general, we live traditionally, Dan, to that question specifically. In fact, I just did an event here at I think it's Key Creek, is a winery area out here in Jersey, and we spoke to a group of about 60 people and talking about just that. What happens if rates drop? If they do get cut, how does that affect markets? I think the first thing is you're going to have pure excitement, obviously from the business community. That's going to unlock a lot of liquidity that's been there, and I think that's going to put some of the maybe monies that's been sitting on the sideline to work, which just by default is going to push markets in general. I think obviously that's going to get some of the, we'll call it in your lane. You guys know this better than I, but some of the real estate market moving as far as homes being bought and sold, which is going to be an exciting end of year for a lot of the folks that are on this call. But in addition, I think for us, one of the things that we've looked at, guys, whether it be globally or domestically, is our opportunity lies really through the lens of focusing on things that participate in demographic shift. So by that I mean, I always like to say it this way: money doesn't go away; it just moves. And so what we want to be doing is paying attention. It's like the old game. Remember when you move the shells, where's the ball? Where's the ball? That kind of thing. We want to be in a place where we're paying attention to where money moves. So with a lot of the different types of real estate that we're involved in, private equity, as well as other things, it really, if to us, we're a little bit agnostic as far as market shift up and down, rate cut up and down, because we're looking for momentum, and that helps us kind of mitigate a lot of risk when we do what we do. So I do think it's going to push markets, though. I really do. I mean, I would be very, very surprised if we don't end this year, if we get a strong rate cut with a strong bullish market. That would be I would be surprised of that. Let me say it that way.
So
Yeah, and something
go
else I
ahead.
would just wanted to add to that real fast. Is I just saw a stat that money market accounts just hit their highest level ever as far as the
Yeah.
amount of money in them, $7 trillion.
Yeah.
And now the
Yeah.
Fed is expected to cut 3 times this year.
Yeah.
Those will get a haircut. So potentially ahead of that, people might start to look at other assets and options as that return gets diminished there. So
Well, Dan, I think they will, because I mean, let's think about it this way. You got certificates of depreciation, then you got money market accounts, and these people are, as I call it, losing money safely. So at the end of the day, they're not keeping up with inflation. I'm not saying there's anything wrong with safe money per se, but as you and I both know, not all money markets are even completely secure. I mean, look at '08, what happens with Bear Stearns and all that stuff, Lehman. So I agree with that sentiment completely. And I think you got trillions of dollars that's been waiting on the sideline. Trump's in. Are the tariffs going to work? What does it look like? All of this unrest. Is he really going to be able to do what he does? And I think now we've had enough flavor of the reality that the momentum is occurring, that I don't think there's going to be any alternative other than deploying some of that capital that's just sitting on the sideline.
So I just want to clarify what these guys are talking about so everybody understands it. So there's a lot of money, as Dan said, most money ever in money market accounts. Those are going to be really tied to the Fed funds rate, as far as if the Fed reduces rates a quarter or a half or 3/4, then those money market rates will be reduced by that. So people might have money in a money market now, and they might be pleased with the return of somewhere in the neighborhood of, let's call it 4%.
Uh-huh.
But at 3.25%, if that's where we're headed, that might be something that will cause them to make, as Michael just said, make that money move. Now, we hope selfishly for us that it tries to seek higher yield in things like longer dated maturities. And that's why Fed rate cuts help longer dated maturities. But if the other alternative is other investments or the stock market, which is why oftentimes stocks do well in periods of time when the Fed is cutting. There's no guarantees. We all know that. But I just want to make sure everybody's on the same page and everybody understands what we're talking about here is the movement of money that is triggered by the Fed easing and why that tends to happen.
Barry, that's a great point. And one of the things that I'll say to all of the folks that are watching as well, sometimes people, we've heard it said before, people will chase ideas or chase investments. One of the things that you don't want to do, this is my strong caution, is don't just, oh my gosh, this thing is just going to blow up and you back the truck up and go crazy. Make sure you're diversified well, make sure you're thoughtfully thinking about what you're doing. Make sure that you're invested in what you're doing. I mean, by the way, for some of you, based on where you are in the totem pole, if you're younger and starting, maybe a great investment might be in your own business. So you can actually acquire more business down the road and continue to, grow what you're doing. So just be thoughtful about why you're doing what you're doing. No knee jerks here, and diversify well along the way. So I completely agree with that sentiment, Barry.
So let's get down to what we want to make sure we focus on here is how we've got whatever 425 people on the call right now. Some of those people might want to look for ways to reduce their tax burden, but also those 425 individuals listening likely have a big book of business of clients that as we want to make sure that we are the trusted advisor, because that's what this is all about, and especially with competition from AI, we want to do things that that an AI competitor can't do. So
Yeah.
therefore, what we're going to want to focus on, I think, here is how can we explain to those individuals on the call right now, or for them to be able to teach their clients what tools are available that really are not very well known,
Mm-hmm.
but highly effective that they
Yeah.
can reduce their tax burden?
Yeah, Barry, it's a great question, and I'm going to give the baton to Steve here in just a minute. But before I do, I think the biggest thing, guys, that I would think about, because obviously, I grew up. If you don't know my story, I had a private wealth firm for years. Now I kind of run a multifamily office. I've built and sold an RIA. I've been involved in building other RIAs. I've coached a bunch of advisors in the past. I say that because the material point of what Barry just said is very, very, very important. A lot of people, when they look at their businesses, they can be in a place where they're operating in a fear-based mindset. Oh my gosh, technology and AI and all this stuff, it's going to take me over, which fear is nothing more than false evidence appearing real, really, right? So we want to say, how can I, or how can you, really, that's why we're here, continue to add significant value, as Barry mentioned, to your clients and the folks that you're working with? That's the glue that keeps them stayed to you, as opposed to just researching. They may research, but they'll come back to you. So I think one of the things that I would say is, as been mentioned already by Barry and Dan, is some of these strategies may be applicable to you specifically. That's option one. Option two, some of these strategies may and probably are applicable to some of the customers or clients potentially that you have. So how can you add value to them? And obviously we could talk about what that looks like, is presenting some information that you could potentially use for some of the folks that you're working with as well. But I guess when you think about that, obviously the more value you add, the easier it is to retain the families you work with. And so when we look at saving money in taxes, what we want to do is we want to kind of take it from the simplified approach, which is where a lot of people live initially, where they're talking about, investing money into a SEP IRA or investing money into a 401k. Those are basic approaches. Being in a situation where maybe you use your house, obviously, for the Augusta roll. And so, some of those are basic approaches. Now, not everybody's using some of those things, but some basic approaches. One of the strategies that we love, obviously, Barry, where we initially connected, was utilizing the easement space, Section 170 of the IRS code, and giving ourselves the ability to, in a lot of ways, take property, land, and participate in the highest and best use of that property. Do a lot of research around it. In fact,
So Michael, just let me frame this, okay? Because I just, you're getting into some really important technical stuff, but just let me frame it for everybody, because there's
Yeah,
something both
please.
Dan and I and many people within the MBS Highway family that were on the call last year have been working with you guys on. So essentially, what this is it's an investment that you make. You're going to lose on the investment, okay? So you're going to lose the value of your investment. However, because of the way that it is structured in a legal manner that allows a multiple of your investment to be written off. And I know that each one might be different, but the one that you put me in, we were able to receive 5.5 times that investment as a write-off against income. There's restrictions, which you'll talk about, 30% of your adjusted gross income, all those things, have to fall within the legal limits and guidelines. But essentially, let's just to use an example, okay? If you were to invest, this may apply, may not apply. The numbers may be big or small. I'm just going to try to use round numbers. If you invested $100,000, you lose the $100,000, but you get a write-off of roughly, in the past, what it was $550,000. Now, depending on the tax bracket that you're in between both federal and state, if you think about that, that means real cash. If you're in the 40% combined tax bracket, that would put you in the neighborhood of a $220,000 benefit in dollars, in less tax that you would have to spend. So you invest $100,000 and you get in dollars $220,000. It's essentially an investment that pays, you make $120,000 profit for your $100,000 investment. That's just the way to look at it and to frame it. So I wanted to make sure everybody understands that before you kind of go through exactly what it is and the details of it.
No, it's well said. And thank you for the framing there, Barry, because that's exactly the simplistics of it, guys. I mean, the deals this year, and as they've been, are actually, they're not quite a 5.5, but they're a 5-to-1. Now, what we've done is we've structured some things where there's going to be some capital that'll be sent back in 3 to 5 years, which is great. But the goal, I saw somebody put a little comment in the chat there. That is the goal. The goal is when you invest money into these deals, which, by the way, have been around since the 80s. They've been passed by Congress as part of law for these been around for a long time. And the goal is to literally make 100% return on your investment. So if you're going to give the government X amount of dollars, you want to shave that obviously significantly. Barry, one other thing that's very interesting about this that you obviously know, and that's one of the things we discussed about, was the fact that whether you're in a place where you're trying to do different types of real estate investments, we'll talk about a few options there in a minute, and how some of that works. With this, it's really pretty simple. Are you an accredited investor? Does it make sense financially for you? You wire the monies and kind of you're done. There's no rules, there's no regulations, there's no hours of work that need to be done, which makes it quite attractive to many folks in the industry. And one of the things that we look at, like exactly the two properties or projects this year, there may be a third coming online, but one is in North Carolina, the other one is in Virginia, all minerals underground. And essentially that's the highest and best use. We have all the engineer studies and reports and all things done that we could literally go in and mine a project. And then what happens is we get to utilize what's called the highest and best use value of that project to have a flow through deduction on our taxes. So it's really a beautiful thing. These do close up fairly quickly. The biggest parameter from what Barry said is really thinking about, what the need really is. One other thing that I want to mention, I think is so crucial, is the way that these deals work. Okay, easement / fee simple type deals. The fee simple, it can only apply, as Barry said, to 30% of your income. So simple math, simple round numbers, might be higher or less. But let's say your income was $1 million. You could literally then deduct $300,000 of your income from this deal. Now, what's really neat is, let's say your income was $1 million and you just so happen to have a capital gains event this year as well. Maybe you sold a property or you sold something else that created a capital gains event. And let's say your total capital gain event, I'm going to make real round numbers because the math is easy. Let's say the real round numbers make your total AGI for the year 10 million. So your ordinary income is $1 million, just as an example. And let's say your AGI is 10 because you got 9 in cap. Well, what's nice about this is this structure specifically, actually the way the IRS code works, attacks your highest taxed income, which is ordinary income, first. So what it gives us the ability to do, if that AGI is 10, we can literally deduct 30% of the 10, which is $3 million. Okay, now we may not need that much. We might want to just deduct $1 million as an example, but we can deduct up to 3 million. So you do the reverse math, a 5 to 1. So for $500,000 that you put in, you get 2.5 million of ordinary income. For 250 you put in, so on and so forth. But what happens is we actually are able to use this deduction to literally wipe out, in that scenario, all of ordinary income, which is your highest taxed income. And then maybe you're only paying taxes, or you use other strategy to deduct the
Okay,
cap.
so
So
I'm
that's
seeing
powerful.
I'm seeing some of the questions, and I know, Mike, God bless you. You go very fast here. We follow you, but for someone who's listening to you for the first time, let's make sure everybody understands, because I could tell by some of these questions that I'm seeing pop up here, and I just think I have a good handle on our audience.
Please. Yes.
So here's where we are, team. So let's use some simple numbers, okay? So let's just say if you have someone who is making $500,000 a year. Okay, so on $500,000 a year, that means that you can shelter, or you can use this tool to shelter up to 30%. So 30% of $500,000 is $150,000. So that means that you would be able to reduce your income from 500,000 to 350,000. So therefore you would pay, depending on your tax bracket, whatever it comes out to, $60,000, $70,000 tax savings. And for that, the investment that you'd have to make is somewhere in the neighborhood of, if you take the 150,000 and you divided that by 5, it's about a $30,000 investment. So you're investing 30,000, you're getting $150,000 tax deduction. You're limited to that on a $500,000 income. And then, forgive me, and then what occurs is that $150,000 less income you have, if you're in the 40% tax bracket, it results in it, and that combined state and federal, that gives you 40% of 150. It's a $60,000 cash benefit for your $30,000 investment. And I do want to clear one other thing, because you talked about these easements and highest and best use. Let me just break it down for you, everybody. What Michael's done is he's got these investments that are just regular land. So if you say, okay, I'm going to invest in this land, and then you would decide to donate it, you'd basically get 1-for-1. I'm donating what I paid for it and this and that. But because Michael has done the research and his team has done the research where he's found that there are things like mining and minerals that are below the land, then what you could say is, well, I'm donating this land, but the land isn't just what I paid for because it's gone up so much in value. So therefore, you are legally allowed to take it on its highest and best use and higher value, which in this case is 5-to-1. I hope that clears up a lot of the stuff for everybody. And Michael, Steve, I just want everybody to be on the same page. This is so important, and I think it's important that they understand it.
No, that was good. And that was, keep it simple, stupid, right? Yeah, it's a beautiful thing. It's really taking a look at, guys, I mean, the old adage, a lot of people don't know what they want because they don't know what's available. And so, our job has been for years. I mean, I was this way when I was on Wall Street and did a lot of things in the financial firm. I do the same in the tax side. I want to pull back the curtain and say, okay, what are some of the things that significantly wealthy people are doing, and why are most people not familiar with it? And unfortunately, Barry, and this, a lot of CPAs that exist out there are just kind of plain vanilla. They're really historians. They're in a place where they look back and they either say you owe this much, or whatever. And so our goal is to say, let's look at the code. In fact, one of the gentlemen on our team, Ryan, his full-time job, I wouldn't do it, but his full-time job is literally to study the code. He coaches 3,000 CPAs in America for them to get their CE credits. So there's a lot of research and bandwidth that's done behind here along the way. So, but that's a great analogy, and that's really what it is. A great explanation, Barry. It's a 5-to-1, very simple. You'll get some of the monies back later, but it's kind of immaterial. The main reason you do it up front is the goal is to say, if I'm going to put in 50, my goal is to save 100 in taxes. That's really the goal.
And the key points here is you could do this for your 2025 strategy.
Yeah.
Which is very helpful as I can't believe we're already in September. So you can kind of start to get an idea of where you will be towards the end of the year in income and what your tax liability would be. And therefore, you could start thinking about, do I need to start planning on ways to reduce my tax liability or shelter? And the other thing, too, is if you're estimating it, and, Steve and Michael, we did this with me. We did it kind of early on because I wanted to make sure I got into them because I know they tend to kind of close out. And I wasn't sure how much. So I went a little overboard, and I was not able to take the whole amount because the amount I put in was greater than the 30% that I was allowed to offset. So what's great about it is you can roll it to the next year. So you don't lose it if you overestimate, I think it's an important point that you could do.
Yeah, it's a great point. You get to roll it for 5 years. So as an example, Barry, let's say you put $100,000 in and you get $500,000 of benefit. And you're in a situation where maybe your income for the year is such that you can't use the entire 500. Let's say you could only use 300 of the tax deduction. So there's technically in that scenario 200 left. Well, that 200 carries over to the next year. And if you don't use it the next year, you can carry over to the next year. You have 5 years to do it, which is a beautiful thing.
People are asking about, a couple of people say it sounds like a great strategy, but does it increase audit risk?
Yeah, my thought on that is no, and it's not just thought; it's a real tested theory as far as my world application. Because I've been doing this stuff since 2011. What I can tell you is I have never had a client or myself personally. Remember, everything we bring to the table, whether it's this, whether it's hotel investments, whether it's multifamily, whether it's whatever, everything that we bring to the table, I'm involved in first. And so, I'm kind of the guinea pig for years and a lot of this stuff before I bring it to the table. So I've been doing this a long time. I personally have never been audited. I've been in business 25 years. And in fact, by the way, Barry, it's so interesting. I remember back in 2004, one of our first clients mentioned to me, now this was before I was doing these deals, but I'll just share this because I think it's interesting. He said, hey, I always extend my tax returns. And I said, why do you do that? He said, well, because the IRS always updates their systems in August and September. And so when you extend your return, your audit capability is much lower. Now, whether that's still the same or not, I don't know. But the bottom line is no, on audit risk. Number two, what I will say is you may read material, and there are a lot of things that have been done on here where you've seen, quote, conservation easements and then fee simples. Those are two different animals, so keep that under the understanding. But in the past, conservation easements were on, we'll call it they call it the dirty dozen, but a list that says, hey, wait, there's tax advantages here. It's not illegal, nothing's wrong with it. But that's now off the list. That list it's been moved off the list because it's a viable real investment. In fact, the Trump organization, the current presidency, they're a big fan of this stuff. As you know, both boys are clients of ours. So we're in a place where we're doing a lot of great work here to say, let's move the ball forward to ensure that we can get the kind of regulation needed. Now, the deal itself, I do want to clarify this. The deal itself is in a situation where it will actually probably has a chance to get audited, but it has no effect whatsoever on the investors. Before 2016, 2017, there were laws that basically said if this gets audited, then it goes directly through. And Barry and Dan, in your situation, you would have felt the audit as well. But because the rules changed then, the audit lives and stays at the deal side alone. And these deals, again, the only reason the audit comes in is to determine whether or not these are viable, real, and all kinds of other things. So there's so much research that's been done for deals in the past. Remember, not everything on Google is good, but when you do Google and look at some of this stuff, you're in a situation where you find out a lot of these deals were not made and designed correctly. You're also realizing that they're being maybe some groups are just kind of jumping in and trying to make money instead of long sustainability. For us, this was an add-on because we already have a private wealth business. So everything that we do, we want to make sure it's clean and clear.
Yeah, so just to catch up a little bit here,
Please.
just define an accredited investor for everybody.
Steve, you want to jump in on that?
Yeah. So that's essentially, and really, guys, I want to encourage you with this. I see a lot of questions coming in, accredited investor, what types of income. I think that's what's best about our team. I specifically talk to each and every client on the tax side. We work with about 130 to 140 high income earners every year. And I spend the time to share with you what's the best income to deduct. We can deduct W-2, 1099, S-Corp income, K-1 income, but it really just depends on your situation. So if you do have questions about that, I encourage you to reach out at our team. We're going to have contact info at the end. But accredited investor is somebody who makes 250,000 or more, or has a investable net worth of 1.1 million or more without the value of your personal home. And realistically, if you're not making 250,000 or more, this investment is not for you. In the higher tax states, it really starts to make sense whenever you start hitting that $400,000 income. And then if you're in Texas, Florida, where there's no state income tax, it really starts to make sense around $600,000 in income. I hope that, clarifies that for the group.
One other thing I wanted to add is, and correct me if I'm wrong,
And I just want to clarify that because I think you just said something by accident. You said in the higher tax state, in the lower tax state. So the lower the tax state, the more income that you should.
Sorry. Yes, exactly.
You got it.
But I feel like when we talk about this, most people are thinking of the benefit just based on their income, their earnings from like their job, right? But we see crypto near all-time highs and hitting all-time highs this year, asset prices, stocks, right? So if you're going to have big gains from selling some of that, of course, that could be mitigated as well through something like this, where, even if you don't reach those areas, as long as you're accredited and you can do the deal, it still may make sense if you're kind of trying to cover some of those gains.
Yeah. Steve, you want to jump in on that?
And look, our team is looking to add value. Everybody's situation is different. I think a lot of you guys that we've worked with, you guys are in a variety of different states, variety of different situations. I know some of you guys, if he's listening, I know one of our clients from MBS is a huge crypto guy out in San Diego. But with these exactly, we want to make sure when we're recommending this, our goal here is not to sell a product. Our firm has been built around building plans and adding significant value to families. If this makes sense for you and you're going to get an ROI, our team is going to share that with you and show you what the numbers will look like. Because with a capital gain situation, if you're in a low tax state like Florida or Texas, where it's only 20% capital gain, it's not going to make as much sense. But if you're in California and it's a 20% capital gain, and then you have to pay the state tax, which is 15% on capital gains, then it's going to make much more sense. And that's really where our team comes down and makes sure we get all the information for your situation and make sure we're making the right recommendations, for your family and for your clients.
I did see something, Barry, that I want to mention. I saw come through. Somebody said, I don't know who it was, but it said something about, can this be used to offset taxes on IRAs when conversions to Roth? So let me give you guys a little bit of a marketing thought here, if I may. Yes, short answer is yes, because think about it. When you sell or when you convert IRA to Roth, that's ordinary income, right? So let's just say you guys have in your Rolodex a kitty of advisors that you interact with, maybe the financial advisors that you do business with, that you refer business to, et cetera, but they don't necessarily have the ability to be in a situation where they have a tool like this. So now you can walk in and present a tool where their clients now you're getting 2-3 layers deep. Their clients are in a place where they might have $3-4 million in an IRA that they want to convert some of it along the way, and we can offset this and really wash it down with an investment like that. So that's a great question that somebody asked there.
Yeah, and then I'm seeing a couple of things. Someone just asked about if capital gains change. Well, if the capital gains tax change, I'm sure it won't be retroactive to 2025. So this is really planned for 2025. But then it's just a math equation. Then it's just whatever you fall into. If it's 20% for long term, if it's ordinary income for short term, if you make over $400,000 a year, it's 23.8%. So all those things that you have to kind of think about. And then a couple of people asked, who does the land get donated to? I don't know if that makes a difference, but do you have an answer for that question?
Yeah, I do. It doesn't make a difference. Sometimes it can be donated to a land conservancy trust. I'm actually in the process. I'm having a conversation where there's a gentleman that runs a group that is all about building strong families and boys and men and kind of, that kind of thing. So they actually are looking at using some ground to have camps where they can develop kids and develop, some other things that way. So that might be one of the places we could literally, we could donate it anywhere we want. We could donate it to a church. We could donate it anywhere, but oftentimes it's land trusts or other things like that. Obviously part of the goal there is that they do not sell the ground for a period of time and they keep it. But once it's donated, it's out and gone. One
All
other
right.
thing that I want One other
No,
thing that I
good.
want to share there for you guys also, just a little side note to put a little feather in your cap. Um, you're in a situation where, let's say you want to go whale hunting. Okay, let's say you have a family office or you have a wealthy family that you want to kind of assist with in purchasing a real estate or just kind of, whatever, however you're adding value to them. On the family side, I don't want to spend too much time here, but I just want to throw this out for you. Okay. So we just talked about, and Barry did a great job of simplifying the overview and the offering of the fact that we can, you put in 100,000. I mean, you can do the math, whether you put in 1,000,000 or 50 or whatever, but you put in 100,000, you're going to get a $500,000 ordinary income deduction. You're going to be able to deduct 30% of your income. So if you're making 500,000, you can deduct 150 this year. Making 1,000,000, you can deduct 300. We talked about how cap gains works as far as being able to deduct that as well. But what's very interesting is on the family side, back to the whale hunting, on the family side, if you have large families that you want to work with, family office, et cetera, you're now in a situation where we can literally design and develop a custom plan just for their family. And when that happens, they're in a situation where they can now use that to deduct up to 50% of their income, not 30. Now it goes to 50. And they have 15 years to use that deduction. And that deduction can be spread through nephews, nieces, relatives, sons, brothers, anyone in that family structure. It's a really, really unique opportunity when you're connecting with, now this is whale hunting specifically, but folks that maybe you have a patriarch that wants to buy a $50-60 million deduction themselves and utilize it for their family. Maybe they have a family business or a family office. So it's just something to think about. It's a much more powerful tool. And that's something just kind of in the feather in the cap. But for what we're talking about today, 30%, et cetera, but that is available as well.
So we'll move on because you have some other great ideas as
Yeah.
well. So we don't want to just stay on this one, but here's what I want everyone to do. I think it's very constructive if you all just want to take a minute and just pen and paper, type it out, whatever. Let's just take an example. Okay. Let's just be real conservative, real easy. Let's just say you have someone who's making $300,000. Okay. So if they're making $300,000 and they'd like to use this tool to shelter their income, so how would you do the mathematical equation? What you'd say is, okay, you can say shave off 30% of that income. So what's 30% of $300,000? It's $90,000. So I can save $90,000 of income, which is great. So how do I figure out how much the investment is? You know, the investment's 5-to-1 benefit. So you take the $90,000 that you could shave off of your income, divided by 5, it's $18,000. That would be the amount of the investment if your income were $300,000. Now, what's the benefit? Well, I saved $90,000 in income, and let's just assume for a second between your state and federal, you're at 40%. Again, I'm using round numbers, team. Okay, so let's say if it's 40%. So 40% of $90,000, that's a $36,000 cash tax savings. So I invested 18. I lost the investment because it's been donated away, but I now got a $90,000 write-off, which resulted in $36,000 in cash. Net result, I put in 18, I got back 36. Just before we went on, I thought that might clear up some questions for people. And sometimes if you do the math, it just helps. That's all.
It's very good. And Barry, that was really good. I appreciate that and simplifying the process. You know, and you'd mentioned something before we move on here that we want to look at as well. If you are in a situation from a tax perspective where you are, let's say, paying quarterlies, okay, it's a great time to think about, okay, instead of paying this next quarterly or whatever it is along the way, let's not pay that to the government. And let's take that money that we would have paid and invest it into a deal like this, which gives us significant tax savings. And now that quarterly goes away. And then next year, the goal is to get in front of it and minimize the amount of quarterly monies that you pay. So that way you can use more of your money to your advantage. That's really the key. Steve, do you want to bring this slide up and we'll jump on to a couple of the other things?
Yep. So, and I see more questions coming in. I encourage you guys, if you have questions, you feel like this is for you, we'll have our information at the end. I'm happy to walk you through it, over the phone.
So let's bring up another idea, guys. Let's make this
Yeah, so bouncing off of, tax strategy for 2025. Obviously, you guys know this, the one big beautiful bill has added a lot of value. 100% bonus depreciation is a big part of that. You guys know there's certain asset classes. You guys, may have clients buying commercial assets, residential assets. There's great opportunity, not only just with buying it personally or buying it for your company, but with also some of the investment strategy that we have for families. We'll get into some of those benefits. Most of you guys know what bonus depreciation is. I'll give you a couple seconds if you want to look at the recap, read this, but I'm going to jump to the next slide. A couple of the highlighted asset classes that we see for bonus depreciation: car washes, truck stops and gas stations, convenience stores, hotels, and then I'll get into these last two here. But these, car washes, truck stops, and convenience stores, these are on special depreciation schedules. I use truck stops for, as an example. They are on a smaller depreciation schedule versus a residential property or a commercial property. So with 100% bonus depreciation coming back into place, this allows us and really gives us the ability, when we do the cost segregation study on a truck stop or gas station, because there's petroleum on the land, to accelerate that all into the first year. And
can you give us an example? Give us
let's say, for example, we had a client who put $100,000 into a truck stop or gas station project that we're doing. With the accelerated depreciation from the cost segregation study, that deduction from their $100,000 investment is going to be roughly a $220,000 to a $250,000 tax deduction. But there's really two different ways that tax deduction can go. It can be a passive income deduction, or it can be an ordinary income deduction. I'll start with the passive income deduction. If you are not a real estate investor, real estate professional, or if you we're just fully engaged in real estate activities. If you are not that type of person, this is going to be a passive income deduction. So that's going to come off of other passive income that you have. So if you own long-term rentals, other pieces of real estate, other private passive income streams, that is going to help that income.
And Steve, how about as it would relate to things like K1s, or could you deduct it against K1 income?
Yeah, so that's a good question, Barry. It really depends on that client situation. I think from a
Mhm.
passive income deduction benefit is, let's say in this deal, it's paying a 10% income per year. Most of these deals pay an 8 to 10% income. That passive income deduction is going to help make that income that we're receiving from that really a limited partnership project as tax-free as possible. Or
Hey,
even
Steve, let me jump in real quick. I just want to I just want to give everybody just a big picture here as he's kind of running through this to simplify it for everybody too. So when we look at your income, like when we look at a client's income as an example, we start out, we say, okay, there's several tools that we can use to package together tax deductions. The first tool that we talked about in length is essentially a 5-to-1 multiple. That's a stronger multiple. The goal is to shave significant tax. The other things that we will add into the mix, which some of what Steve are talking about now, might actually attack different taxes on different line items of your return. So it's a complementary situation. It's not a competitive situation. Very important. But remember, these other ideas are actually a little lower in tax deduction as far as for your benefit. However, they have an investment component. So the goal is to see a high teen to mid low 20 IRR on these investments in addition to the upfront. So you have one side, which is a much stronger multiple, 5 times that attacks the income down on paper now for savings. Then two, we blend it with other structure that also has an investment component that has nice IRRs, typically 3 to 5, 3 to 6 years in length, and has some distribution while we're waiting to get our capital back, but we get tax benefit along the way. So we want to blend it together well to say, okay, based on the situation and based on the income, how can we mitigate and reduce these taxes by using multiple strategies? But continue, Steve.
Yeah, no, that was great, Michael. Yeah, really, the idea is whenever our family comes to us, we want to attack things in a way that's going to most benefit to them. And based off of these deductions, sometimes, if a client's entering retirement or building their portfolio, we'll have them in a few different partnerships, a few different real estate projects. And the great thing about the tax deductions from the big, beautiful bill that these will allow is it's going to make all the income from those other passive investments that they're in as tax-free as possible and really increasing the yield on the return. I think an easy way to think about it, we'll use California, for example. Most retirement portfolios are equities and bonds. And if you're getting all of your income from a bond in California and you're a wealthy family, if that bond is paying you 5%, that's going to be taxed at 50% because it's an ordinary dividend. So what's your after-tax return on that 5% yield from the bond? It's 2.5%. That's your tax equivalent yield. But when you're using investments like this that are not only paying a higher income, but have the tax benefit that come from them, it puts you in a place where what you're actually holding at the end of the day in retirement or just your investment portfolio is much higher than the other vehicles that are commonly used.
And Steve, just to go through, you as you were going through this, like the car washes, truck stops, this and that, and I love that Michael explained that while the write-off in year one is not as aggressive, you do actually have you're making an investment. You're not donating it, but
Mhm.
you were
Mhm.
also going to explain, Steve, that it can be it can work to offset passive income, but tell us how it can offset ordinary income.
That's a great question, Barry. So with
Mhm.
fees, taking them against ordinary income, there's got to be a couple of things in place. So, number one, if anybody out there is a real estate professional, I know a couple of you are that we've worked with, a real estate professional, we need that designation for it to be an ordinary income deduction. Real estate has to be an active activity for you versus a passive. So, what is that? That's 750 hours or more in a real trade activity with real estate or having over 50% of your time in real estate. Now, to make an easy example, if you're working as a mortgage broker 40 hours a week, you would need to work 40 hours a week as an active real estate professional. So we commonly see this used if there's a stay-at-home spouse, there's some rental properties that spouse is working there, or if they're a mortgage broker slash real estate agent. I've also seen that before. So if
So, Steve, let me jump in here real quick for folks just to make sure that they're hearing what you're saying. So, what he's saying, guys, is sometimes, okay, sometimes right out of the gate, you can say, gosh, I don't qualify as a real estate professional because my full-time business is XYZ. I can't do that. So that doesn't apply to me. Next. Well, I want to say kind of slow down, not so fast. Because one of the things that we've done with our team is we've created a very simple kind of hold your hand strategy to kind of step back for a minute and think, say, okay, let me think about my spouse. Let me think about some other things that I might be doing. How can we maybe come alongside, which we have with certain clients, help them log necessary hours to get the things necessary for them to actually be a real estate professional, to use this as the ordinary side instead of just the passive side. So I just want to challenge you in that thought. Maybe what you do, as Barry mentioned earlier about the notepad write down, maybe this is a great time to write down real estate professional, how can I do it? Or can this apply to me? Because just you and yourself, remember, a lot of people don't know what they want because they don't know what's available. And so just by Googling, reading, looking, you may say, okay, it doesn't apply to me, and throw it out, baby with the bathwater. I'm challenging you to say, don't do that. Let's slow down and think about maybe there's some ways strategically that we can help you qualify for that. Obviously, all legally, okay, but do it in a way that we can really make sure that this
And
is
let's
maximized.
just say if they could not do that,
Yeah.
then just like with any other segregated cost structure, you do have to be careful, because while it could be an incredible tool to accelerate that depreciation, it's only going to work against offsetting passive income. Is that right, guys?
Yeah.
Yeah.
Okay,
If
so
you
you have
don't,
to be careful with this, team. If you're listening to this, I mean, I love segregated cost structure. I think it's fantastic, but the key is, well, maybe what you could do is, could you help us understand what are areas of passive income
Yes.
that people that people could be saying, okay, well, define passive income for me, so maybe there are ways that I could take advantage of it.
Go for it.
yeah, Yeah, I think, you know, number one, the most common thing is having a long-term rental. So what's a long-term rental? You know, a building could be commercial, could be residential, where you have somebody staying in that place and paying you, you know, a premium to stay there for, you know, 6 months, a year, 2 years, 5 years. That is passive income because that's not a, you know, an activity that you're, you know, actively managing on a daily basis. It's
Uh-huh.
really something passive. That's the most common passive income that I see. And then whenever we're structuring portfolios or helping families with investments, all of these different limited partnerships that we're helping families get into, whether it be, you know, multifamily, whether it be self-storage, truck stops and gas stations, car washes, that limited partnership is feeding you passive income. If we have $5 million into these certain limited partnerships, it's paying us 10% a year. That's $500,000 in passive income that these tax deductions will offset, which
Yeah,
is, you know,
I understand. Let's just break it down more simplify to just define other areas. Like, for example, what if you're getting a dividend income, interest income? Are those considered passive income that could be offset by these?
yeah, so dividend and dividend ordinary income from other things, most of the time that is not considered passive income. That is considered, you know, an ordinary dividend. So it's very specific based on, you know, the type of thing that they're receiving, that income that they're receiving.
And remember, Barry, and you know this very well because we've had lots of conversations about this, but that's why when Steve started, I went back to the beginning and said, there's a blending strategy here. And if we're going to bake the cake, we want to look at all of the different things that we can put in as ingredients and say what does and does not apply based on the situation. We might have someone that says, okay, all of these things, all these 5, 6, 7, 8, 9, 10 things are going to apply to this one person. And then this person over here, it's like, okay, maybe only 1 or 2 apply. So it really does depend. We want to bake it well and make sure that we are using strategies that complements and not just, like I said, competes.
So
Okay,
just
so
just for a quick summary here, right? Just to kind of tie a bow around this. So for the one that we're talking about right now, which is investments like the truck stop, for instance, you're not going to get the 5x multiple on the value of the investment there, like the first fee simple one that we were talking about. But you do get a deduction, but you also are, this is an investment where there's going to be a nice internal rate of return over the next several years, but it doesn't necessarily make sense to do for everybody. You want to try to blend it because
Yeah.
if you are able to do it against passive income, well, you probably have to have a lot of, or at least some longer term rentals that could go against that passive income that you're earning. If you want it to be, active or ordinary income, well, then you need to qualify as a real estate professional. Most people think that they probably can't because they're working full time as a mortgage professional, but there may be some creative ways that are legal that you can have your spouse logging different hours and working on that stuff. So it's probably worth a conversation to see if both products blend. But I just want to be clear, the first one, as long as you meet the income requirements and it makes sense, you don't have to worry about that ordinary passive. It's something you could do against W-2 and have a nice benefit. Is that?
And
You're right. You're 100% right, Dan. So think of it this way. The first thing that we discussed today takes no requirements other than the fact that you're an accredited investor, and obviously financially it makes sense for your situation. That's number one. That's the first deal. So it's easy as long as you can DocuSign and wire money, you can do it, and you're accredited. Step two, the other deals are, you're exactly right, Dan. They're investments with a tax component. And I want you to think about it this way. So people are in a place where, let's say they're saying, hey, I'm going to invest X amount of dollars a year into something. Maybe it's the markets, maybe it's other type of investments in general. Maybe it's real estate. There's a lot of things out there. By the way, the real estate that we use, by the way, are smaller deals, 200 million, 100 million, sometimes as small as 10 million. I've done a lot of stuff in helping even companies IPO over the years. And a lot of these big REITs are just, in my opinion, not where to go. They don't get out quick enough. The returns are not strong enough. So I want to say this. If you're in a place where you're saying, hey, I'm going to invest my money, gosh, why not invest it where you have a strong high teen, low 20 IRR potential that gives some distribution while we're waiting for that 3 to 6 year turn. And it has a tax benefit as well. So that's kind of why we bring some of these to the table. But yes, option one, nothing but accredited, wire money, sign DocuSign, check, you're good. Option two, other thoughts, we blend them based on, it's a little bit more in-depth research to see what's appropriate.
so before we run out of time, two things. Is there any other quick ideas you have? And then how do people connect with you if they want to potentially inquire and learn more as to how this could potentially benefit them?
I do want to share, and then Steve's going to, I don't know, Steve, if you have that last slide, which has your number, they can text you to keep it simple. But, another thing, there's actually several other things, but I'll just highlight one, Barry, for purposes of time. Oil and gas is a great investment. We've done that last year as an example. And again, same thing. Now, this is an investment play. Okay. This is for the return of capital plus making money. And so, this oil investment deal is typically 3 to 5 years. We do not do the trickled out effect where it's like, hey, we're going to wildcat. It's 2025. We don't do that. We're looking to find proven reserves. We're jumping in. We're being a part of. We're out in 3 to 5. We're improving the procedure. Last year, clients were able to receive a 97% deduction on their taxes through what's called intangible drilling costs. So if you invested $100,000, you got $97,000 of that deduction that you could take off of your ordinary income. Please keep in mind that's a different line item than the fee simple. And then now it's a 2.5x roughly investment return in 3 to 5 years. I did see one other quick question. It says, what's the length of time? I don't know what it was referring to, but I will tell you most of the time when I look at investments and we look at investments, we're in a situation where 3 to 6 years is the window that we want to be in. Sometimes it's sooner, but that's typically the ballpark. We want to know that there's an exit. We want to know that there's incentive on the developer to exit. And we don't involve ourselves with any developers that I haven't been involved with myself and known for a long time that we know do a good job of taking care of the money. So there's a lot of things, but oil and gas is another great easy play. It's not something that you have to qualify for anything. It's kind of like the fee simple initially. It's just putting money in. It's an investment, and you get a nice deduction as well. Steve has a slide on the end with his number, Barry. But any other thoughts that you have there?
Just a couple of quick questions. So the idea of this would be for 2025. Good questions that are being asked. Greg's asking a question, just wants to make sure if you invest it, let's just say if it's in October, you make the investment, you will get because the land will be donated before the end of the year, which is why time runs out, and it's a 2025 write-off against your 2025 income. So that was one question. And then Matt goes, hey, Matt, do you guys handle the tax filings as well, or just the advising and investment? So typically speaking, like the way I used it is I got a long-time accountant I've used, but I think you guys also provide accounting services. I don't know if I'm 100% correct.
But they provide all the docs that you need,
Yeah.
and they even give instructions to your accountant,
Yeah.
essentially. I mean,
Yeah.
it's like I just hand that thing off to my accountant, and he's like, okay.
Yeah. Yeah, we want to kind of keep it simple, and then also, yes, we do returns, but that's typically only for folks that are doing $1 million or more in income. But at the end of the day, that is possible. But as Dan said, we want to make it real simple in your structure. We're going to make sure it's the right thing when we have the conversation, and I'll go down those lines. But a lot of other things there, guys. I would just suggest. Here's all I would say for the fee simple things. They will fill up. I'm not. It's not a sales pitch. It's real. We got about $22 million of value this year. We literally, I think right now have 18 or 19 million of it filled. So that'll probably fill up, I would say no later than the end of September, October, the first deal, October, the second deal. We do have the capability of rolling out, Barry, just for your knowledge, a third deal this year. But what we need to know is intent and incentive or desire for folks, because that way there's a lot of preparation to kind of bring that to light. These are not evergreen deals. Once they're full, they're full. It is what it is. And that's just how these operate. So just so you're aware of that. But anyways, Steve's going to share his number.
And listen, I just want to tell everybody, again, full disclosure, I've done it before. I'm going to get together with these guys and do it this year. It's a great strategy. I found it to be extremely helpful. My accountant loves it. So,
Me as well.
Dan's in it. I mean, so we would only bring these guys on first. When Michael first told me about this and Steve first told me about this, I was like, wow, this is really, it's a no brainer. It's obvious. I just got to be real careful and make sure it's good. So I did, as you know, Michael and Steve, we had several calls to make sure that everything was protected for me. And, there's nothing that could, so once I was comfortable, once my accounting team was comfortable, we went ahead with it. And of course, we're just going to do it again. So I just want to let people know that. So.
Yeah. And sometimes you have accountants that may not be familiar with it. Mine was one of them. But once I fully explained it, and especially with the documentation that these guys provided, he was completely accepting of it.
Yeah. And we're only bringing this stuff to you guys because, look, this is just to try to add value for you, to try and save some money. I know last year wasn't a banner year for the mortgage industry, but you may have clients that fall into this, and there will be banner years. So you should be aware of this. Know that you've got this as a protective measure to plan ahead.
Yeah. No, we appreciate the opportunity to share info to everyone on the call. And again, think about this in relation to not just you personally, but get your business cap on, and how can you go start connecting with people in your space to add value to them as well. We're happy to kind of discuss what that looks like. Steve, do you want to share the slide with your info and they can just shoot you a quick text?
Yeah,
that's just what we've done to keep it simple.
Yep, I can share it one more time. And then if you guys are taking notes, feel free to send a text to 561-855-4635. I'll repeat that one more time, 561-855-4635. And in that text, include your name, the best time to reach you, best time to chat, and your estimated income range. And our team will reach out to you and we'll get a call set up.
Yeah, please share that additional information in the chat, guys, just to help us in simplification of time, not just, your name. Share some of the other info that he shared there. Would greatly appreciate that. And we'll be sure and see how we can add value.
Well, thanks, everyone. As always, we appreciate you guys. We hope that this was helpful for you guys. Perhaps it'll save you some money. Michael, Steven, you guys are always great, and appreciate you, Di and Dan and Megan. Thank you so much for being on, everybody.
Thanks so much, everyone.
Hey, thanks
well
for
done,
coming
team,
on,
and
guys.
Take
we'll
care.
send you the
See you,
recording.
everybody. Have a blessed day.
Thanks, everyone.